Good morning, this is Brennan Decima, owner of Decima Wealth Consulting. In our last video, we talked about a simple retirement framework, growth, guarantees, and liquidity to help bucket out our retirement savings to navigate through market volatility in retirement. Today, we're going to talk a little bit about risk management. So let's take that growth bucket we discussed, and there's really three ways to think about risk. We can park it, we can navigate it, and we can insure it. So parking it is saying, hey, this is my risk bucket. I know I need long-term growth, but I just do not want any volatility. So think of that almost as putting the car in neutral. The advantage of being in neutral or park is the odds of you hitting something and it being catastrophic are slim to none, right? It could happen, it's just very unlikely. The downside to that is it's going to take absolutely forever to get to where you're going, or you're not going to get there at all. So again, personal preference, we may be fine where we're at and not need to go anywhere, and it's appropriate to park. The next is we can navigate it. So let's leave the house, let's get to our destination. We want to go somewhere with our savings. We want to get to a higher balance, right? And when I think about navigating it, we're out on the road, we're driving. When conditions are clear, and we're talking about this risk bucket, when conditions are clear and you're driving, speed limit may be 60, but if it's sunny, there's no cops, there's no hazard, there's no storm clouds, brake lights, you may go faster than the speed limit. You may have your foot on the gas, and it still feels very, very safe. Same thing with the market. When there's a lot of positive economic reports, headlines are not chaotic, market's moving in a trend, it makes sense to be a little bit more risk on. Vice versa, when you're driving and speed limit's 60 or 65 and there's storm clouds everywhere, there's brake lights in front of you, there's sirens going, you may not still go 65. You may go a little bit slower than the speed limit. Same thing with investing. We've got turbulent times, doesn't mean you have to go your speed limit. You can navigate and shift risk around to areas that make a little bit more sense for the current conditions. And then finally, you can insure your risk bucket, right? So with driving, again, we don't go out on, most people, hopefully you don't go out on the road without car insurance, right? You're protecting against a catastrophe. The same thing applies with investing. You can transfer that risk and insure that risk. Things like annuities where, I had a client recently do one where the upside potential was 12%, right? If the market gave them 12, they got 12. If it gave them 20, they still got 12. But on the downside, they can never walk away with less than what they started with. They have transferred all of that risk where the upside is still better than parking it, right? Still better than cash. But the downside is, you don't walk away with anything less than what you start. So in that growth bucket, a number of different ways you can do it. You can park the risk and be happy with where you're at, low stress, but you're not going anywhere. You can navigate that risk where you can drive based off the speed limit the economy gives us, or you can transfer that risk and find a way to get protected growth. No right or wrong, and combinations are fine as well. If you're interested in how we can explore that for your retirement strategy, email me at brennan@decimawealth.com or leave a note in the comment.